The market has been distracted of late by bigger picture stories of U.S. protectionism and fear of global trade wars, but will turn its attention back to Fed policy normalization on this Friday, another major theme in 2018. A lot of the story on this front has to do with the inflation outlook in the U.S. and whether or not there will be additional signs of upward pressure that would put the Fed in a position to consider a more aggressive rate hike timeline than the one currently being priced, which has the Fed hiking a total of 3 times in 2018. At the last Fed meeting, it was revealed just how close the Fed was to projecting 4 total hikes in 2018, and if the average hourly earnings component in the monthly employment report, deemed to be an indicator of inflation, comes in above forecast on net, this could be the catalyst that pushes Fed guidance to officially call for 4 rate hikes this year. The average hourly earnings component has become the feature component in the monthly jobs report because NFPs and the unemployment rate have been running at very healthy levels for many months and are unlikely to inspire much volatility even if they miss, given the fact that misses can easily be dismissed as one-offs. But if hourly earnings come in above forecast on net, this will be US dollar supportive as it strengthens the case for rising inflation and pushes yield differentials further in favor of the US dollar. A higher average hourly earnings print will also be a negative for the stock market, as faster rate rises will make equity market valuations less attractive. At the same time, if hourly earnings come in softer than forecast on net, the opposite reaction is expected, with the US dollar more vulnerable and US equities in position to find encouragement from a Goldilocks result that points to a slower normalization process. As far as the data goes, NFPs are expected to drop back down to 180K from 313K previous. Average hourly earnings, the year-on-year is expected to tick up to 2.7% from 2.6% previous, while the month-on-month is expected to tick up to 0.2% from 0.1% previous. As far as the unemployment rate goes, it's expected to drop to 4.4% from 4.1% previous, and this would take the unemployment rate down to its lowest level since 2000 and leave unemployment at or near maximum employment levels. As far as the participation rate goes, it's expected to tick up to 63.5% from 63% previous, trying to work its way out from a 4-decade low. That's all for now.